So all the students who joined the live, is audio clear? I'm sharing the YouTube link on the group. You can please check it out. So whether audio and video is clear or not, please confirm. Okay, everyone. Good morning. Dhiresh Karthik, yes, good morning. Bhuvija, good morning. Raghavendra. Next, Hemavati, and all others who joined live. A very good morning to all of you. So, very good morning, everyone. So, today we are going to start with the CA Final Advanced Financial Management exam oriented batch for the May 2025, which is also applicable for November 2025 CA as well as for the CMA final exams. And with regard to the particular batch, exam oriented batch, as I already said, from a week since we are telling about this batch, This is a result oriented, result focused batch wherein we are going to cover the entire AFM portion in 130 hours, such that it will help you in your revision. It will complete the batch in less time, and we will do all important problems that are applicable for exam. Later practice you can do. So in exam oriented batch, as I already promised, we will be doing somewhere around 430 problems we will do. Clear? So sir, in regular batch normally 430 will be there, but we will do in EOB also 430 problems. Okay, regularly we will add another 200 to 250 problems. But since this is exam oriented session, I will be first covering out all the key points and the important areas. Okay, and very importantly, sir, I am joining for this exam oriented batch without having any background regarding the AFM subject before. Is it really suitable for me? Just listen to the first 2 days of the lectures. That's it. No basics required. Because I will take care of each and every basic that is required to understand the subject. Okay? Why? I will explain certain things before we start with. So, the student should first understand what is happening inside this examination of AFM. See, AFM is such a subject from the institute point of view wherein questions will be tested in examination not just from the study material or RTP, MTP. Questions will come from that. I don't deny. But basics of AFM, if you don't have, it becomes extremely difficult for anyone to crack certain points inside the question. Sir, what do you mean by basics? Basics means basic of how to multiply, as to how to divide, as to how to equate to denominators, as to how to equate to numerators, how to understand exponential powers, how to understand logarithms, how to understand certain basic calculations on calculator, okay, how to use a square root, how to use a cube root, fourth root, fifth root, and so on, shortcuts in calculator, okay, and most importantly, the concepts of time value of money, and very importantly, the basics which are not covered by the syllabus. Sir, what do you mean by basics not covered by the syllabus? Latest examination means the exam which is conducted in the month of November 2024. Okay, I will show you the question. Okay, when we come there, I will show you the question. That question was asked in the chapter called as a capital budgeting. Do you know what question came in exam? He first asked to calculate net present value. Which value? Net present value, and certain other things inside that. Actually, that concept is not in the syllabus. Okay, it is there in CA inter syllabus. Basic calculation of NPV and analyzing the results is a general thing that was given in CA inter exam. Okay, and on that they again extended the question from final. Means if there is a question of one page, half the question is on CA inter portion, remaining half the question they asked on final. What will be the argument of ICA as a student when you are learning the advanced version of capital budgeting? Will the faculty don't teach you the basics? They assume that they will. And whether we teach or not, you keep it away. It's an imperative for the student to understand the basics of capital budgeting before you start with capital budgeting is the prime assumption of the institute. So therefore you cannot argue with the institute that it's not there in the syllabus. NPV, how can you ask in exam? In question bank or in the suggested answers or in the study material, did you put any reference to NPV? I will not. When you are calculating adjusted NPV in CA final, without understanding NPV, how can you calculate adjusted NPV? These are the arguments of the institute. So therefore, please listen carefully. In this EOB, to keep all the student at a level of comfort zone, I am going to cover from the bare basics. Okay? And no magics will be done. We will consistently put a hard work and complete our portion. Okay? And before we start with the session, in the first day itself, I wanted to clear certain things. In this session, I am going to cover full syllabus. I repeat, I am going to cover full syllabus. When I say full syllabus includes theory. Full syllabus includes real options. Full syllabus includes weather derivatives. Okay, and wherever a new lecture comes, okay, wherever a new concept, for example, real options is there. Which one? Real options. That was added and I kept in the YouTube previously. Now that will not be there. I will record in this EOB only very clearly. Those who have taken the Google Drive classes also, the new lecture only will be placed there, such that everyone taken the classes will be at a par level. Okay, clarity. Number 2, theory will be covered or not. Yes, exclusive theory material I am sending you. Okay, books dispatch has started, because we got totally, in total, we got totally 223 admissions as on yesterday. Okay, we created 5 WhatsApp groups as well. Group 1, 2, 3, 4, 5 is running now. 6th we will start once another 50 also is completed. And such a humongous response that we have got for the classes, I was amazed. And thank you very much all of you for putting so much confidence on me. Okay, keeping all these aside, there is a lot of responsibility on my shoulders now to cover the syllabus and complete the syllabus on time, and to have a quality discussion in this advanced financial management exam oriented sessions. Listen, with regard to the syllabus, there are so many people who joined for the first time to the EOB without a regular. For them also I should do some justification. Therefore what I am doing is, I will cover for everyone from the scratch. Means when a concept start, I will explain how the concept came, why that concept came, what would have happened if that concept is not there, formula, derivation, analysis, application and hypothesis of the concept, and then questions we will do, such that when you see a new question in examination, your approach will be completely different from that of all others. Okay, this is the thing I wanted to tell. Initial first 2 days of the classes, okay, initial first 2 days of the class, I am going to put live on YouTube. Okay, first 1-2 days or 3 days I will put live on YouTube. Okay, reason I will tell you. There are students who did not join WhatsApp group. We are slowly adding them. Actually, once you buy the classes, a WhatsApp link will be given to you. Some have joined, some did not join. Group 3 we created, some students didn't join in that. So we are adding now. Group 4 already filled, 50 means 50 already there. Group 3 lo only 47, 48 are there. Now we added and made it 54, 55 also. So the thing is, for the first 2 to 3 days, I will put live on YouTube. Okay, initial days I will start at 7 to 7:30 between, we will begin and complete. But once 1 or 2 days completed, once we start listening on the app, it will be a 4.5 hour session, and I will cover all the concepts, the sequence of study, how we are going to analyze this concept, and what is our approach. Okay, problems, from where we are going to do each and everything I will tell in the today's session clearly. Before we start, those who joined live, are you all clear up to here? Those who joined live, are you all clear up to here? Yeah. So let us now begin our journey of success. I repeat, we are going to embark on a journey of success. Definitely, last time I got 113 exemptions for AFM. Now all those who joined live, plus all those who will take the classes later, I must see an exemption mark in the exam. And moreover, last attempt people said that's a difficult paper. Why they brand difficult, I don't know, when you do everything. Okay, so there is no such a difficult easy paper. There is only one thing which is called as a question paper. Okay, don't unnecessarily over brand it and over hype it. Difficult paper, easy paper, all these things will not be there. Okay, and finally, before we start, these classes are applicable for CMA final also. Reason I will tell you. CMA final I took 2 batches. 2 batches I have taken from the study material of ICMA, wherein I proved everything, that the questions of ICA and ICMA are matching absolutely. Okay, 95% of the questions of CA and CMA both are same with numbers. Then what is the point of not taking this? So that's why these lectures are applicable for both CA as well as for CMA final. And for the CMA final students, there are two topics. Digital finance concept is that's a small theory, 2 hours concept. Keeping that aside, practical concepts for 2 chapters are there extra for CMA. What is that 2? Actually not 2, it's 1.5 chapters. What is that? One chapter is called as a leasing decision. Second one, that 0.5, half the partner, capital budgeting for CA final, advanced capital budgeting. For CMA final, capital budgeting, okay, means what? Full capital budgeting from the basics till the risk and uncertainty, everything is applicable for them, okay. But I told you now already, all the CA final students, just now I told, exam la capital budgeting is a dangerous chapter. Last attempt at 12 marks came from capital budgeting. What I am going to do with regard to the capital budgeting is, whether CA final or CMA final, I will start with basics. So that 0.5 will be anyway covered for CMA also. For CA also anyway I will tell the basics. Without basics I don't start. That's not my way. You have to know the basics. Okay. Without understanding how the NPV table came, it is a nonsense. You have to learn things on capital budgeting. So I don't do that. That's not my way of teaching. You should know the scratch. From the basics you need to know what is happening in NPV. Okay. Why we are writing year cash flow, PV at the rate of PVCF, why not year PVCF, why the traditional system of conventional model of NPV tables came, what is the PV factor, why it is that percentage, why we are writing cash flow, why we are not taking the profit, okay, all these things we are going to analyze from the basics. So there is no concept. Advanced capital budgeting can be understood if and only if you have a clarity on basics of capital budgeting. Mark my words, or else we will definitely fail to do the questions in exam. You should have the basics, no doubt about it. There is no second thought, there is no second point. Okay. So therefore only one chapter will be added for CMA final, that is leasing decisions. That concept is not there for final CA. CA final it's not there. So I will cover that only one chapter separately. I will record. Okay. Why to tell unnecessarily the statements? I will not come live for that. I will record leasing decisions chapter. 8 to 10 hours it will take. I will cover the problems on the CMA material and I will cover. Okay. 99% syllabus since it is same, like security valuation, bond valuation, portfolio management, mutual funds, derivative options, derivative futures, foreign exchange risk management, all the risk management, everything is same. So when everything is same, these lectures are applicable not just for the CA final, also applicable for CMA final students. Okay, with this basic intro, shall we start with the class, everyone? Very good morning all of you. We are now going to embark into the success journey of CA Final AFM. EOB is going to start now. So please put a message yes. We will begin with the class. I will first show you the initial pages of the new study material. Everyone waiting for your reply fast. Please put yes. We will start. Okay, very good, super. Yeah, let's begin. And moreover, if at any point of time, okay, whether in YouTube first 3 days or on the app, whenever you have a doubt, okay, I will be consistently seeing the chat. I will be consistently seeing the chat also on the app. If you have doubt, stop me first, because there is no concept of asking questions after the class. After the class also we can have webinars where I will be present for you to resolve your queries. But on the spot resolution of query is very important. Clear? For example, if I am a face-to-face, how comfort level will be there for you? You can stop me and you can ask a question. That thought process should not come into the mind of a student. I am not there face-to-face, or else he would have taught me very clearly. No, I will teach that very clearly even in live. If you have any doubt, please throw the doubt on my face. I will take care. Immediately, on spot, in live. Okay, because I have no insecurity problem. Okay, if you ask the question when people are there, I can't answer, no such question will happen. You ask me on the face in the class. Okay, any kind of doubt I am ready to solve, because that's my responsibility to clear all your doubts. Okay, let's begin. So everyone, please open the notes, write down. So write down here. Subject, advanced financial management. Also applicable for CMA Final. So to which attempt it will apply? May and November 2025 CA Final, and respect to CA Final, CMA Final means June December la same corresponding. Okay, the respective CMA Final also these will be applicable. Next, if there is any question, I will be checking the questions from your side. Yeah. So attempt May and November 25 CA Final exam. Next, books or materials or the resources. One colored handbook. Colored handbook 1. Covering 7 chapters. Covering another 7 chapters. Theory and summary book. This theory and summary book is the star, because that contains the complete theory in 25-30 pages. Along with that, 25 pages like covered entire AFM. Means a day before examination, if you wanted to refer the formula, concepts, etc., fastly you can refer the summary. Okay, this is a fast track referencer. It is a fast track referencer. Okay, colored, everything is colored, black and white question illa. Okay, so next, so books and materials and resources also I said. With regard to the dispatch, we dispatched it, it will reach you in some time, but in order not to hamper the first initial days of our lectures, I will provide the PDF also. Okay, once the books are ready, okay, no problem. See, even before the books reach you, I will share the PDF also of the material what I am going to teach. You can put it with you, don't take any printouts unnecessarily, don't spend money. Okay, just keep the PDF with you. Anyway, I will explain everything in the class. You can at least see on the phone or you can see later. No problem. I will provide the PDF for the initial days till everyone receive the books. Okay, no worry in that. So next one. So next one, medium of instruction. It's 100% English. I'm not going to use any local regional languages. Okay, none of them. Telugu, Tamil, Hindi, nothing. 100% this is English. That's it. Absolutely, this is a 100% English class. Okay, so the subject advanced financial management, paper number 2, the attempt, books and materials, medium of instruction. Okay, next. Now let us go into the main concept. Write down. The syllabus. Okay, so let us begin with the understanding the syllabus. First thing, plus newly added topics as well. So what are all the newly added topics? Let us see. See the screen once. Okay, see here once. First, name of your paper. Just a minute. Okay, see here. Name of our paper, Advanced Financial Management. Paper will be for 100 marks. Objective is to acquire the ability to apply. So application skill is what expected, and a real-time application. Financial management theories and techniques in the strategic decision making. So you are going to give decision under final. Internal decision will be given very rarely. It is all about calculations. Okay, also called as a working knowledge. This is not working knowledge. This is a professional expert application level knowledge. So when it comes to the contents of AFM, section 1 will have one theory chapter first, financial policy and corporate strategy. Later, risk management, advanced capital budgeting decisions. Next one is a security analysis, security valuation, portfolio management, securitization. This is a section 3 part. This is a theory chapter. Mutual fund, derivatives, Forex, IFM, IRRM, BV business valuation, mergers. Lastly, one theory area is there, startup finance. Startup finance. So with regard to these chapters, these are the significant changes that are made in the study material. Okay. So financial policy and corporate strategy, in that changes are made. External funding requirement has been added. When we come into this concept theory, I will discuss about this. Already this is there in my old material also, but I kept this in the chapter called as corporate valuation. Now they are changing it to the chapter called as financial policy and corporate strategy. This is not a new topic. This is only replacement. Okay, means when they are putting in one chapter, now they are putting in a different chapter. That's it. Beyond that, nothing has changed in that area. So like this, for some chapters, chapter 3, 4, 5, 6, 8, 9, 10, 11, 12, 13, some concepts are added or removed, or some rectification of errors are made. Okay, see here, some corrections have been carried out. So sometimes corrections are made, sometimes if there are any mistakes, now they are changing the mistakes. Okay, means they have removed the mistake and they kept the more logical and sane way of understanding the concept. Okay, let us write down here syllabus. Sir, everyone who joined live, are you all with me? Everyone who joined live? Yep. Okay. Syllabus, I am going to discuss the syllabus from how we are going to approach the AFM EOB. See here. First, segment wise I will divide. Write down, sir. Everyone write along with me. You should first have a grip over this, what we are going to do. Segment 1. Share valuation. First one, share valuation. So share valuation chapter not there, na sir, in the study material. Actually, there is a chapter called as a security valuation. What's a valuation here? Security valuation. That security valuation have two segments, share, bonds. Here we are going to first cover the shares concept. Okay, so you can safely write down share valuation. This is a part of the chapter security valuation. Next, portfolio management. Share valuation, portfolio management. First one, share valuation. Next one, portfolio management. Next, business or corporate valuation. Mergers and acquisition. Mutual funds. Mergers and acquisition, mutual funds. So share valuation, portfolio management, business valuation, also called as a corporate valuation, mergers and acquisitions, and next one is the mutual funds. Next one is the mutual funds. Listen carefully. These all will form part of one set of discussion. Okay. Along with this, there is another area which we are going to discuss. So first one, share valuation. Next one, portfolio. Next one, business or corporate valuation. Next one, mergers acquisition. And next one will be mutual funds. Next one will be mutual funds. Next. What is the topic here? Security analysis. This is the segment 1 discussion. Right now, segment 2. The first one in the segment 2 we are going to cover is segment 1 over. Now we are coming into segment number 2. Bond valuation, money market instruments. Bond valuation, money market instruments. Bond valuation and money market instruments. Next one is the segment 3. Write down segment 3. So in the segment 3, number 1. Segment 3, number 1. Derivatives and Forex. Derivatives and Forex. When I say derivatives, it will cover derivative options, derivative futures, swaps, everything will be covered in that. And finally, the third area, IFM, International Financial Management. That is an extension to the chapter called as a Forex. Okay, so that's the segment number 3. Segment 4. Risk management. Risk management. Advanced capital budgeting. Advanced capital budgeting. Theory and others. Okay, the theory and others. So these are the total 4 segments: share valuation, portfolio management, business or corporate valuation, mergers and acquisition, mutual fund, security analysis, bond valuation, money market instrument, derivative, Forex, IFM, risk management, advanced capital budgeting, theory and others. Okay, next, this is all about the syllabus in the form of segments. Next, write down sequence in EOB. Okay, we are going to follow a sequence in EOB. What is the sequence? I will write. Sir, please listen to this very carefully. This is a sequence we are going to follow throughout. Okay, here and there one or two chapters sequence may change, but 90% I will try to follow the same sequence, because these are to be followed from the exams point of view. Marks point of view, these are having more weightage. If it is a normal regular AFM, I will start from the concept of security valuation. After that, I will go to the concept of mergers acquisition, corporate valuation, mutual funds, bond valuation. Like that I will proceed. But here in this case, I am not going to do like that. I am going from the marks point of view and difficulty point of view. Means what students are feeling extremely difficult. First, let me cover those. Okay, let's begin. So, what is the sequence in EOB? Number 1. Basics and time value of money and some maths. Sir, what maths is, sir? Sir, let me tell you one thing. Half the people will be allergic in AFM just because of the mathematic formulas that are involved. Why they feel allergic? Because they don't know how they came. That we are going to do here. Okay, whether AFM or regular, that concept doesn't change. You should have a knowledge on a basic math, how the formula came. PV factors will be there. You will divide for discounting, multiply for compounding. Why we should do that? If you understand that, next time you don't do the mistake. Okay, rather than concentrating on what, from now concentrate on why. Okay, a lot of difference will come in your understanding pattern. Okay, let us begin. Next one. So, basics, time value of money and some math. First we are going to cover that. Next area we are going to start is undoubtedly the most important chapter. Guess the chapter? Guess the chapter here. Those who are joining live, answer. What will be the first chapter? First chapter, bumper bonanza. Reveal the suspense now. In the tomorrow live class, we will start with that. Guess the chapter? Anyone who already know? We are going to start with Forex. We are going to start directly first with Forex. So, first starting, let us cover 15 marks area. That's it. Your burden will be lost. After that, what you can do? For the next 3 and 4 months, we can start practicing on Forex. Okay. So, first we are going to start with Forex. After basics. Without basics, I will not start. First basics, everything will be completed. After that, Forex. Next after the Forex. Next after the Forex. We are going to start with share valuation. Once after the share valuation is done, okay, now once after the share valuation is done, another 15 marks area again. One small chapter, one big chapter, one small chapter, one big chapter. Okay, next one is Portfolio management. That will be the next area we are going to deal with. What is the name of the chapter here? Portfolio management. Next. Just a minute, yeah. Just a minute. Portfolio management. Once after the portfolio management, risk management. This is a sequence in which we are going to follow, and I will strictly abide to this. 1 or 2 I may change, but 99% we will follow, because accordingly students will also plan. Suddenly after Forex I should not tell I will start with derivatives. Plan will be disturbed. So therefore in this plan only we will go. Maximum 1 or 2 changes I might make according to the situations at that time, but absolutely we will follow this. After risk management, again derivatives. In derivatives there are so many variants. Options, futures, currency options, currency futures. These are the things we are going to cover. Options, futures, currency options, currency futures. These are the 4 we are going to cover in the derivative. Sir, IRRM, let me explain. Sequence. First let us understand 70%, 60% derivatives. Later that 35% we will discuss separately. Okay. Next. Mutual funds. Mergers and acquisition. Business valuation. Mutual funds, mergers and business valuation. IRRM and swaps. In IRRM and swaps, multiple concepts will come. Interest rate swaps, currency swaps. So interest rate risk management, interest rate swaps and currency swaps. These are the areas in the interest rate risk management area. Interest rate risk management area. Okay. Final touch. Advanced capital budgeting. The reason why I am taking advanced capital budgeting at the last, I will tell you the reason. Reason is, after the advanced capital budgeting, then the theory and other concepts will start. Then the theory and other chapters will start. Okay, so other chapters means small calculations, and by the way, business valuation, when we are dealing with it, okay, and when we are doing the IRRM and swaps, bond valuation also will be covered along with it. Okay, so theory and others, this is how we are going to take up our discussion. Okay, and with regard to the concept, before IRRM and swap, you can mark there and write down, before the IRRM and swap, bond valuation will be done. Okay, bond valuation will be done. After that, IRRM and swaps, advanced capital budgeting, some theory and other topics. Okay, so this is how we are going to do. Now let us understand the probable marks. Okay, I am not going to give any assurance, means because it is unpredictable, we can't predict. It's not that easy to predict how the marks will come in exam. So probable marks, in general, how the marks will be given. Probable marks, basics and time value of money, nothing, but we need to learn Forex, share valuation, portfolio management, risk management, derivative options, derivative futures, currency option, like that separately we can't tell, but all together the derivative segment will come for 10 marks. Mutual funds, five marks to 8 marks. Mergers, business valuation, bond valuation, IRRM and swaps, again these 3 chapters put together will be coming for advanced capital budgeting, theory and others will come for 10 marks. This is how the total breakup of your subject will be. At a bare minimum level, okay, 8, 5, 13, 23, 28, 38, 38, 5, 43, 43, 6, 49, 49, 6, 55, 55, 6, 61, 61, 8, 69, 69, 10, 79, 79, 10, 89 is minimum. Okay, in this they will make additions etc and makes a 100 marks paper. Okay, so like this they will prepare. In general, the marks will come in the same way. Clear? So in this pattern, if you prepare, this is the pattern of our classes now. So first we are going to start with the basics. Next we will be going into the area called as a Forex. Next we will be going into the area called as a share valuation. Next to the portfolio management. Next risk management. Next derivatives. Derivatives like in options, futures, currency options, currency futures, IRR, interest rate swaps, currency swaps, all are one segment. We will divide it into 2 segments. Mutual funds, mergers, business valuation, bond valuation, advanced capital budgeting and theory and other chapters. Like this we are going to take up our entire discussion. Okay, next. Class timings, it will be from 11:30 a.m. and here please listen carefully. Okay, listen carefully. My point is 7 a.m. to 11:30 a.m. 30 minutes to 45 minutes break I will give. Okay, I will not stress towards that 4 hours. I will take a 30 minutes to 40. Even I want that break. So 30 to 45 minutes maximum will give a break to you, a decent amount of break where you can refresh and come back. But listen carefully, those who are joining the live, okay, for them, along with the live, I will give Google Drive with one view. Okay, Google Drive with one view. Whenever you miss any topic on a particular day, with that one view you can cover. Okay, so my point is, listen carefully, as much as possible, please try to come live only. If you don't come to the live, then there is no point of joining this session. Yeah, you can buy normal UOB GD lectures directly. The entire point of these classes is live I have to discuss with you. You should ask me the questions. You should solve questions along with me. Okay, that consistency and hard work is required at least for 30 days. So when you do that, then you can do your best in exam. So therefore, some amount of consistency, some amount of discipline is required. So we will start the class. First 2 days or 3 days, I will start at 7:30. Okay, early only I will leave for 2-3 hours I will take. But once the Forex starts its pace now, I will take full session, and on Sundays, I will take extra sessions as well. First, to those who joined live, yes or no for this? Sunday I am going to take extra sessions. This all in your best interest. I have to complete the syllabus. Yes, everyone, Sundays. Okay, like I will tell you, yeah, why we will take extra session on Sunday. Sunday, once you take extra 2-3 hours na, and morning I will cover, and evening I will again put the session and we will start. At the time, the advantage with the session when you have on Sunday is, during that time we can complete one small chapter itself on that day. Means when you spend 6-7 hours na, normally 4 hours session. If you spend extra 2 hours, 6 hours, we can complete chapter like mutual funds. Then so one chapter will be complete on a day. You can do all these questions after that. You can practice. Okay, you can practice. Such that, for example, mutual funds is the risk management chapter, is a very small chapter. It will take somewhere around 3 hours to discuss. Okay, for discussion sake and understanding everything, 3 hours, 3.5 hours required. But after 3.5 hours, problem solving will take 2 hours. Normally, what I have to do, 3 hours session, I will discuss about the concept of risk management. Once everyone in the class are accustomed and understanding the risk management concept, then we will start with the problem. By the time we start the problem, 1 hour the session is completed. Okay, next day again we have to start. In that case, what I will put that risk management chapter on a Sunday. I will start from, I will take 8 o'clock Sunday, but 8 o'clock to 1:30 I will take, such that 8 to 1:30 we will cover risk management concept, theory, basics, problems, everything will be covered, including the latest attempt RTP. Okay, yes, I will extend after 11:30. So like that, from 8 to 1:30 if I take na, Sunday you can take a extra 1 hour of cushion. But from 8 to 1:30 if you start na, the beauty is you will complete the risk management chapter. After that, start practicing. That's it. At the end of the day, comfort is not important. Comfort in understanding is important. Comfort in your behavior is not important now. For us, what is important? You have to qualify. That's it. You have to get exemption. You should qualify. For that, some amount of hard work is required, at least for the coming 2 to 3 months for you. Okay. Next. So class timings will be from 7 a.m. to 11:30 a.m. Google Drive, one view also will be given. If any situation, emergency came where you could not attend the session, that's our responsibility to provide a backup. I should not tell everyone should come to the class. Even some days, some people may not come. Many issues may affect us. So therefore, keeping all those in view, what I am saying is, for the GD view, one view will be given along with it. Okay. For example, today I completed a class. By evening I will upload it. So anyone who missed the class in the morning, at least they can listen in the evening. For this, everyone, yes. For this, everyone clear? Okay. Now listen. So the thing is, 7 a.m. to 11:30 a.m. Google Drive one view will be given to you. Okay. Next, after this, the next thing is how many days will be the session. I planned this session before to complete in 30 to 35 days. Okay, 30 to 35 days I am trying to plan. 35 days maximum. 35 days into 4 hours each. Into 4 hours each. It will go somewhere around 140. Okay, 140 hours. 130 hours is the targeted time. Extra 10 hours I kept. But announcement time I said 40 days. Reason is, if at all 1 or 2 days my health may get affected or some situations, emergency may come where I can't take the class. That's why I kept a 40-day cushion. But sessions 30 to 35 days, so we will complete substantial portion also. Okay, sessions 35 sessions definitely will complete everything, because we are going to take 4 hour session. Okay, 2 hour session, break of half an hour, another 2 hour session, such that clean slate of mind you can sit, do, complete the subject. Okay, but time extension will be there, because my objective is not to keep me in comfort zone. My target is to complete your syllabus much early as possible. For example, if it can be completed in 32 days only, I will try to complete in 32. Later you can practice. Okay, so I will try to complete as soon as possible. Clear? Let's see here. So now the point is, these are all the various things that we are going to understand here. So first of all, everyone in the class, are you all okay with all the terms and conditions of the class? Nothing conditions, I can't keep any conditions on student. I'm just saying you, these are all the terms on which our classes are going to be in the next coming 30-35 days. Okay, so subject is the advanced financial management, paper number 2, CA final, also applicable for CMA final. Attempt is for the May and November. CMA final means June and December. Materials, colored handbook 1, colored handbook 2, theory and summary book. Medium of instruction will be 100% in English. Syllabus covers a full syllabus plus newly added topics. Segment 1, segment 2, segment 3 and segment 4. And it covers the sequence like this. Okay. First, the concept of the point of putting Forex at the basic is, I will tell you the reason. You might not even understand. This is the reason why I kept Forex at the beginning. The reason why I kept Forex at the beginning, I have good 2 important reasons are there. Reason number 1, Forex comes for a sure question. Forex is a sure question in exam. And generally Forex amount around something somewhere around, in general all the attempts, it will come for around 10 to 15 marks in general they will ask. Okay, that is one reason. But the prime reason why I am starting Forex is one such chapter where time value of money will not involve. Concept will not be there. There is only one chapter in your entire syllabus where time value of money will not be involved. Okay, what do you mean time value of money will not involve? Okay, time value of money will not involve means there is no concept of PV factor. You can't see PV factor anywhere in that chapter. Which chapter? Forex. Forex loves PV factor concept will not be there. Listening? So Forex with capital budgeting la PV factor may come. Forex per se has no PV factor. Okay, so therefore what will happen, even a student who don't know the basics of time value of money, he can first complete the Forex chapter. But once Forex is completed, all the remaining chapters are linked to the PV factor. IRR PV factors are there, swaps PV factors are there. Okay, all options and features like everything is PV factor. Portfolio management chapter itself is calculating PV factor. Okay, risk management has PV factor. Bond valuation, business valuation, mergers, mutual fund, where it is not there, everywhere PV factor will come. There is only one chapter in your entire syllabus where PV factor concept does not arise, and that's the concept of Forex. So therefore we are first going to start with the concept of Forex. Now, let us now start with our basics. Okay, let us start with the basics. Even before I start with the basics, first let me explain very clearly. First we are going to understand what is the concept of time value of money the basics of forex, basics of financial management, the approach that we need to have in mind to get that exemption. Why students are getting 100 plus students are getting exemption? Everyone got 70 plus, 60 plus like that. When people said that's a difficult paper, why? How they got? How much students got exemption? Just because I believe in you should understand the concept. You should not mug up the areas. How many problems you have done is not important. How much quality content coming into your mind is important. That's what we need to understand. So let's see. See the screen. Now, advanced financial management, whatever the basics I wanted to cover, I have covered. This is 1 minute. This is about the class. Everyone, please keep the heading. Basics of finance. Basics of finance. I'm not talking about advanced financial management. As a financial management subject, these are the basics. And these basics will help you like anything when you go into the chapters. Without these basics, really that comfort zone will not come when you solve. So many people might think, sir, we are not from math background. Sometimes we can't understand the formula. Why they came, we are going to understand here. Okay. So please, basics of finance. Right on. This chapter alone you are going to write. All other chapters, handwritten notes, everything will be there. Why this chapter you are writing? Reason, you should know the basics. If you write, you will remember. Remaining chapters, anyway, problems you will do, you will remember. Okay. Let us begin. So what is the concept here? Learning objectives, right now. Number 1. Understanding the concept of finance. Understanding the concept of finance. Understanding the concept of finance. So since I am writing the notes, I am putting the document on full screen. Once concept starts, again I will come into the picture. Okay. So if document is full enough, those who are watching on the phone also, it will be visible. That's the intent. Understanding the concept of finance. Second one. Concept of time value of money and its importance in finance. Concept of assets and liabilities. Concept of assets and liability. So understanding the concept of finance, concept of time value of money and its importance in finance, concept of assets and liabilities. So this assets and liability concept is there now. I will explain the idea behind. It will blow your mind. As well, how the assets and liabilities one should perceive, how they should understand it. We are going to have a very close look into the assets and liabilities there. Then you will understand what is a share. You will really understand there. Okay. Next one. Basics of PV factors. Basics of PV factor. Means in that area, we are going to understand what is a discounting, what is compounding, what is continuous discounting, what is continuous compounding. All those we are going to understand in the basics of PV factor, such that other chapters when we start discounting, compounding, continuous compounding, exponential, you will not get a doubt. So concept of assets and liabilities. Next one, concept of assets and liabilities. Understanding the concept of reinvestment in depth. Mark my words, in depth. When I say in depth, never before, never after. You will understand, it will blow your mind. When we go into the concept of bond valuation, there is one concept called as a reinvestment rate. What is this? Reinvestment rate. When you come to the capital budgeting, there is a concept called as a modified internal rate of return. These two concepts have link with reinvestment concept. At that time, we will not put blank faces. When all other students are finding it difficult to understand how it came, just like that, you will solve the problems and throw the paper away. Okay, so you should understand the concept of reinvestment. So how reinvestments will work, if you understand that now, when we come to the concept, how the formula came, how it came, you will not get the doubts. You will tell others, this is how it came. These are how the answers came in the study material. So understanding the concept of reinvestment in depth. Next, so understanding the difference between, okay, understanding the difference between, by a comparison, difference between what is the meaning of market value, what is the meaning of fair value, what is the meaning of value, what is the meaning of price, what is the meaning of cost, we are going to understand there. Okay, along with that, okay, what is the meaning of cost? Next, write down. Understanding the concept of cash flows. How we will understand the concept of cash flows? In depth again. Reason again, I am telling you, the reason why cash flows we have to learn in depth. The entire AFM dependent on analysis of cash flows. Yeah, you must know the cash flows concept in depth. So understand the concept of cash flows in depth. Okay, so what we will understand here, why we will consider always cash flows in FM. Okay, any FM, inter FM, final FM, CFL FM, anything. So finance area, why it considers cash flows, why it don't consider profits. Even profits are given, we will add back depreciation and bring the cash flows. Here cash flow PV at the rate of some percent PVCF. Why cash flows are coming? Why not profits? Reason is there. Okay, there are three reasons we will learn there. Let's begin. So understand the concept of cash flows. Okay, in this we will understand types of cash flow streams. Types of cash flow streams. Discounting versus compounding. Discounting versus compounding. So what is the concept of discounting? What is the concept of compounding? This we are going to understand in this particular basic level. Okay. Last one. Some miscellaneous observations of this particular area we are going to cover there. Okay, some miscellaneous observations we are going to cover there. So these are all the various topics in the basics of finance. Understand the concept of finance, concept of time value of money and its importance in finance, concept of assets and liability, basics of PV factors, understand the concept of reinvestment in depth, understanding market value versus fair value versus price versus cost. Okay. Next, understand the concept of cash flows, discounting versus compounding, and miscellaneous. These are all the various areas which we are going to cover in the basics of finance. Okay. First, before we start, okay, everyone who joined live, put one yes, or you are comfortable up to here. Everyone joining live, put one yes, or you all really comfortable with whatever I discussed till now. Okay, done. Thank you very much. So let us now begin the concept. Okay, first listen carefully. We are going to start with the basics of finance. We are going to start with the basics of finance. Since this is the first day of the class, some may be ready, everything, some may not be ready. So I'm not going to take a long session of 4 hours. Today's session I will take only for 1.5 hours or 2 hours to 2 hours 10 minutes, like that I will take, and I will complete some part of the basics. From tomorrow, please everyone be on time. 7:30 I will start tomorrow also. Okay. So what you have to do is have a single rule notes with you, a black pen, if possible colored pens you have, and along with that please have a calculator. Okay, immediately you need to react and do the problems. So for that it is required. Okay, let's write down, sir. So please keep your mind active in the morning. Write down the notes properly. All chapters we are not going to write the notes, but all chapters we are going to do the problems. Okay, but for this chapter basics you need to have a good grip. So let's write down. First, topic number 1. Concept of finance. Concept of finance. Finance is all about study of money and study of economy. Finance is all about study of money and study of economy. Two things we need to study. One, money. Second, money in the economy. Both should be understood at the same time in order to have a clarity on the concept of what do we mean by finance. Okay, that's the first point. Next. So finance is all about study of money and study of economy. Next one. Okay, first finance is all about study of money and study of economy. Next one. Finance is a branch of Fill the blank. Finance is a branch of. Like this we will have interactive sessions only. You should tell. Finance is a branch of. Finance is a branch of. Waiting for your answer. Finance is a branch of. Very good. Some people already answered. Finance is a branch of economics. Okay. Finance is a branch of economics. Economics will have two branches. Okay, or three branches technically. Normal economics, micro, macro will be there. Second one statistics, and third one will be finance. Okay, that's why if you observe, most of the concepts of financial management contain statistics. Okay, most of the topics of financial management will contain the statistical analysis, because this concept of finance itself is stemmed out of the concept of economics. So the first branch will be the micro, second branch will be the macro, and third one will be the stats, and fourth one will be the financial management. Okay, next. Financial management subject. Sir, financial management and is inter-financial management. No, general. In general, so what is financial management? Financial management deals with inflow of cash, from where to bring the money. This is called as outflow of cash. Where to put the money? This comes under investment decision. So, from where to bring the money, where to put the money, inflow of cash, outflow of cash. Projections of inflows. With appropriate tools. Sir, what is this? One chapter is there for this projection of inflows. That chapter name is business valuation. Business valuation chapter is talking about a free cash flows analysis. Which analysis? Free cash flows analysis. The concept of free cash flows you can understand if and only if you understand the projection of inflows. Sir, always listen carefully. Okay, listen to my words carefully. Whenever you see the financial management as a subject, any financial management, I am not talking about final, any inter-final, anywhere. The first thing you will understand is all the questions contain estimated cash inflows. What inflows here? Estimated. It's not already happened. Finance is all about future. Accountancy all about past. We are not doing accountancy. We are doing finance. Finance is all about what? Future. When I am saying future, obviously there should be projection. When you project something like that, 1 lakh, 2 lakh, 5 lakh, like that you should not tell. Everything you write should have some scientifically appropriate tools you should use to project the cash flow. Okay, on that only one separate chapter for 10 marks is there in your syllabus. 2 chapters rather, 10 marks, 10 marks, 20 marks. Number 1, projecting the cash flows. Okay, projecting the cash flows, how company might perform or company will get in the future, business valuation chapter. So we will value the business. Like that capital budgeting, we will value the project. I purchase a machine. How much cash flows the machine will give in future, that we need to write. How do I know today? With the scientific analysis you must write. Okay. Now you tell me, whenever I say future is, whenever I say, for example, I purchased a machinery. A person asked, how much cash flows this machine will give? How much revenues this machine will give? I said, 1 lakh. 1 lakh 50 and 2 lakh. He said, oh, bond paper written. Vendor who sold the machine to you, he gave any bond paper written agreement? I will give you 1 lakh, I will give you 1 lakh 50, I will give you 2 lakh. Did he write any agreement with you? No. Generally, market they are getting this much, so I am estimating the same. That's what I said. Estimate. Okay. Your estimate is right or wrong, or sometimes right and sometimes wrong. It may be right, may be wrong. Maybe always I may be right, always I may be wrong, or always may not be. Sometimes 60-70% times I may be right in estimate. Therefore, whenever we make an estimate about the cash flows for the future, there is every chance that estimates may go wrong. Means there is a risk involved in that. Okay, how to analyze the risk in this projection? That's what the concept of advanced capital budgeting came into syllabus. So, the projections risk is there. Whenever I project something, projection has a risk. Understanding the risk in the projections is a concept of advanced capital budgeting. That's why if you see advanced capital budgeting in our syllabus, you will find a concept called as calculating the variance, calculating the mean, calculating the standard deviation of cash flows. Why we are doing? The cash flows what you have projected are not absolutely perfect. They are having some errors inside. Understanding that error itself is called as a advanced capital budgeting area. Okay. So please everyone, understood what I said up to here? Once you say yes, I will move on. Again and again I have been telling you, you are the priority. Until and unless you say yes, I will not continue. Okay, done. Be interactive. Yeah, 30 days you spend, your group 1 will be cleared. Life again you need not touch CA final group 1. Group 2 you will take care. Okay, once I come to DT, then I will be concerned more about the group 2. But now I am very much focused on that group number 1. So do properly. Yeah, this will get easy 70 plus. Yeah. And recorded when the students sent me the messages, all those compilation 113 I got. How many students who didn't inform me? So please. So projections of inflows with the appropriate tool. So tell me, financial management is all about what? Financial management is all about inflows of cash. Okay, from where to get the money, outflow of cash, where to put the money, projections of inflows with appropriate tools. After projecting the inflows with appropriate tools, next stage, risk analysis in the projection. What analysis here? Risk analysis in the projection. When I say projection, it is expected to happen, not already happened. Accounts la PV factor will not be there. Reason, it has already happened. Accountancy is a post-mortem. Yeah, already balance sheet over, P&L over, everything over, audit over, accounts prepared, board of directors signed under section 134 subsection number 3. Board of directors signed director's responsibility statement under section 134 subsection number 5 prepared. 134 subsection number 1 signing was done. 134 subsection number 3 signing is done on the board report. Annual report prepared. AOC 2 filed. AOC 4 filed. MGT 7 filed. Everything is filed. Auditor gave the audit report to 143 section. Complied. Everything is over. Then you are coming into picture. Listening. Then the audit will start. Accountancy is all about, okay, accountancy is all about what has already happened. Okay, transaction happened, I will record. Transaction not happened, write down. Projected transaction means I can't write projected transactions. Understood? Projected transactions we can't write. Sir, why sir projected transactions we can't write? Ind AS 115 will be there na. What it says revenue until revenue is recognized, you can't recognize it. Then how to project and write? You should not. So accountancy results don't allow us to do like that. Okay. So finance is all about inflow of cash, outflow of cash, projections, risk analysis. Along with that, it also talks about markets. When I say market, not vegetable market to fish market, I am talking about the financial markets. In this financial markets la there are 4 important segments. Number 1, equity segment, debt segment, derivative segment, currency segment. If you observe, more concepts of final finance is dependent on markets analysis only. Equity segment on a share valuation, bond valuation, all these things will come. Equity segment, share valuation, security analysis, okay, mutual funds, portfolio management, mergers, business valuation will come in equity segment. Bond valuation, money market instrument, debt segment, options, futures, currency options, currency futures, currency swaps, interest rate risk management, interest rate swaps, all these things, forward rate agreements will come under a derivative segment. Okay, normal Forex calculations, international financial management, all these will come under the segment of Forex here. Okay. So how many segments are there? 4 segments are there totally. Okay. So what is the finance? Financial management subject deals with financing decision, means from where to bring the money, Next, after bringing money, put the money. Where to put the money? That's called as investment decision. Third one, what financial management will do? Projections of inflows with appropriate tools. Next one, once you project, there is a risk in that. So analyze the risk in the projection. And after that, markets. Understanding various markets, financial markets I am talking about. In that, equity segment, debt segment, derivative segment, Forex segment. These are the various things that are applicable. Okay. So this is the idea behind this particular concept relating to the markets which are financial in nature. Okay. So equity segment, debt segment, derivative segment and the Forex segment. How many are there totally? 4 segments are there. Understanding these 4 markets is the overall analysis relating to the concept of financial management. So concept of finance we completed. Please write down the notes. Continue. Number 2. So inflow of cash, outflow of cash, projections, risk analysis, markets. Next one, number 2. So learning objectives la understanding the concept of finance over. Next one, what? Time value of money and its impact. So please write down from here, it's very important. Time value of money and its impact. Sir, from here please concentrate. We are not going to discuss anything which is irrelevant, so please listen carefully. First one, time value of money and its impact. Let us understand the meaning of time value of money. See here, I will give you an example. First try to understand properly. Everyone please, all the viewers, concentrate properly. Sir, all in the live. Shall we? So we are effectively starting with our subject discussion now. Shall we? One is everyone. Shall we continue? All those who joined live, reply please. Okay. So the concept is time value of money and its impact. What is the concept here? Time value of money and its impact. Okay. Let us try to understand what is this very clearly in detail. First one, time value of money is a concept where it says that money derives value from the time. Money derives its value from the time. Means time influences money. Money can't influence the time. It is not money value of time. It's a time value of money. Means time gives value to the money. First let us understand one point. When I say time value of money, I will give an example and I will try to explain. Okay, rather than explaining this way, I will explain in the form of, okay, I will explain in the form of the ideology relating to how to understand this particular concept. Okay, so how about this particular concept, how this concept will actually work, let us try to understand. See here, whenever I say time value of money, it is a study of understanding how the time impact money. I will give you one example, listen carefully. I have a 500 rupee note. I have another 500 rupee note. Please listen carefully. I have two 500 rupee notes with me. I have one 500 rupee note. I have another 500 rupee note. How many 500 rupee notes are there? I have two 500 rupee notes with me. Okay. Yes. I kept on table and I said, which 500 is more valuable? Okay. I said, choose only one 500 note. Okay. I kept two 500 notes on the table. You sat on the other side. I asked, choose any one. Okay, that one should be more valuable 500. More valuable 500. Now tell me, which is more valuable? I have on left hand, I have one, on left side I have one 500 rupee note. On right side I am having another 500 rupee note. So you tell me now, which is more valuable? Which 500 rupee note is more valuable? There is no such concept because both are 500 rupee notes. Both are equally valuable. This is what you say. But wrong. A finance student or a finance professional should not tell both 500 rupees notes are having same value. Both are having a different value. Okay. Two 500 rupees notes are kept on the table. Which one is more valuable means what you will tell both are same. No. You should ask him, when I am going to receive these 500 rupee notes, you first tell that, then I will tell you which is more valuable. Understood? I kept two 500 rupee notes. I asked, which is more valuable? Normal person, both are same. But finance professional should not say the answers in the same way. Means both are same, you should not tell. Both are not same. Both are not same. Why both are not same? Reason is, one 500 rupee note is given today. Another 500 rupee note I will give after 1 year. Another 500 rupee note I will give after 1 year. So, Sir, what do you mean by that? Sorry, I will give you example. See the screen. There is a table. Okay. Here I kept a 500 rupee note. Here I kept another 500 rupee note. Okay. I said like this. This 500 rupee note I will give you today. This 500 rupee note I will give you after 1 year. Then I ask which is more valuable. Then you should not tell both are same 500 rupee note. No. Both are printed by RBI. No. Okay. Both are having Mahatma Gandhi on that. No. That's not the analysis. Here Mahatma Gandhi Reserve Bank is not important for finance. Finance requires the time impact. Okay. Understand now. See here. What they say is this 500 rupee note, this 500 rupee note, which is more valuable, you asked. Then you should tell this 500 rupee note is more valuable and this 500 rupee note will have less value than, means this is greater than, so 500 is greater than 500. This is possible only in finance. Okay, generally 500 and 500 both are same, but here 500 and 500 both are not same. 500 is more than 500. Sir, how come 500 is more than 500, sir? This 500 I am receiving today, this 500 I am receiving after 1 year. So when you are going to receive the first another 500 after 1 year, so you are sacrificing the 500 rupee for 1 full year. Okay, so therefore what should happen? When you are taking this 500 after 1 year, they should pay some interest and they have to give. For example, they said 520 rupees versus 500. This is given today, this is given after 1 year, this is given after 1 year. Your return expected, I repeat, your return expected. For example, you invested your money. How much? 500. 550 it became. I said this way, 500 today, 550 after 1 year, 550 after 1 year. This is after 1 year. This is today. Which one you prefer? Your expected return is 10%. Your expected return is 10%. 500 is better, 550 is better. Answer. 500 today is better, 550 after 1 year is better. If your expected return is 10%. Today 500 is better, future 550 is better. Reply. Very good answer here. Both are same. Yes. Both are same. Why? If you take 500 rupee today, invest in bank for 10%, 10% of 500 is 50 rupees. After 1 year it will become how much? 550. So 550 after 1 year is equal to 500 today. So point is, today 500, futuristic 500, both are not same. If really the question comes, today money will be more valuable. Okay, today money will be more valuable. So what you have to understand, time value of money says that money derives its value. I repeat, money derives its value not because of the person holding it. Okay, if Narendra Modi holds 100 rupee note, 100 will not become 1000. If Kaushik Mukesh holds 1000 rupee note, 1000 don't become 100. 100 in the hands of me and 100 in the hands of our Honorable Prime Minister Mr. Narendra Modi. Both the hands, okay, 100 rupee note is same. Value don't come with the person. Value come with what? Value come with the time. Value come with the time. Okay. So what do you mean by the time? The timing of your receipt decides the value of money. 500 rupee, 500 rupee. Both are 500 rupees. For a normal person, both are same. But for a finance professional, you should ask, when you are going to give me this 500? I am going to give you this 500 today. I am going to give you this 500 after 1 year. Okay. Means today money, I am getting 500. Future I will get 500. Which is better? Today's money 500 better, because future is always uncertain. For example, I said, I will give you 500 after 1 year, or I will give you 500 today. Okay, let us say you chose second one, or you chose first one. I will give 500 rupee after 1 year. I will give 500 rupee after 1 year. 1 year I may not be there. 1 year after you may not be there. Both of us are there, but currency notes are cancelled. Anything can happen here. Always future is uncertain. When future is uncertain, how can you tell that this 500 will come? For that uncertainty in future, you are asking return. You are asking return. I repeat for one more time. 500 rupee today, 500 rupee after 1 year. Which is better? If you tell both are same, it's wrong. Both are not same. Timing of receipt is important, not the amount. This 500 when I will receive? Today. Okay, today. This 500 when I will receive? After 1 year. After 1 year, guarantee you will receive. May not be. I may not be there to give. You may not be there to receive. Both of us are alive, we are there, we are very happy. But something has happened, I became insolvent, I could not pay you. So there is an uncertainty in this 500 or not. This 500 is certain, this 500 is uncertain. For the uncertainty of that receipt, we will ask some return. We will ask some return. How much return? That will be expressed in a percentage. That percentage of return you are expecting for the uncertainty you are taking in the cash flows is called as a PV return, also called as a PV factor. That PV factor is nothing but your expected return. Everyone, answer, understood or not? Everyone understood or not? Hopefully everyone has a full clarity. Okay, so what is the logic here? The entire concept of time value of money revolves around two things. One is time, another thing money. So money derives value not because of the person holding it. It derives value from the time. The timing of receipt decides its value. 500 rupee note, 500 rupee note, both are same. But when you are receiving decides the value. Okay, when you are receiving decides its value. Okay. Now, so the time value of money and its impact. Time value of money means what? Let us write down, sir. Let's write the notes. I told the first chapter only notes you are writing. Next chapter onward notes I will give, problems also I will give, solutions also I will give, practice we will do in the class, all the problems. Okay, roughly I will do all the problems. Fair notes you can see there. Okay, let us see. Time value of money and its impact. TVM is a concept where the money derives its value from the time. So money do not derive its value from the person holding it. Money do not derive its value from the person receiving it. So money do not derive its value from person holding it. Money do not derive its value from the person receiving it. Money do not derive from value from the government printing it, but money rather it depends on timing of receipt or payment. So money do not derive its value from the person holding it. Money do not derive its value from the person receiving it. Money do not derive its value from the government printing it. Rather, it depends on the timing of the receipt and payment. Okay, right on. A rupee received today will have more value than a rupee received after 1 year or in the future. Because future is uncertain. And uncertainty is risk. And risk ask for return. And it will be expressed in a percentage term called as PV factor. Okay, so a rupee received today will have more value than rupee received after 1 year. Okay, or 100 rupee or a 1 lakh rupee. I said 1 lakh today, 1 lakh after 1 year. Okay, 1 lakh today, 1 lakh after 1 year. 1 lakh today, 1 lakh after 1 year means how to understand? Today will receive 1 lakh for sure, certain, no risk. No risk. That's why today 1 lakh means 1 lakh you will receive. You don't get any return because no risk taken. I kept 1 lakh rupees on the table. I said this 1 lakh or this 1 lakh. This 1 lakh I will give today. This 1 lakh I will give after 1 year. 1 year after, if you wanted to give this 1 lakh, don't give me 1 lakh. Give me more than 1 lakh. Then both are same. But if you are going to give me 1 lakh only after 1 year, definitely I will choose today's 1 lakh only, because today's 1 lakh is more valuable and it is 100% certain. 100% certain. Again, so many new things you are going to learn. People who might think I know time value of money, now we are going to prove that certain things you still don't know. That's what we are going to target now. Okay, so say rupee received today will have rupee received will have more value than rupee received after 1 year or in the future. Why? Because the future is uncertain. Uncertainty is a risk. When you put money in, definitely will get return means okay. If you tell that may come, may not come, there is a risk involved. Risk is always associated with return. That return is always associated in percentage. That percentage of return we call PV factor. Clear everyone? So that percentage we call as a PV factor. Okay. Now, so see here once what we have written. So first one, learning objective number 1, concept of finance. Time value of money and its importance in finance. Okay. Concept of assets and liability, basics of PE factor, like these concepts are given. Okay, first. Let us write down the third one. Okay, write down. Importance of PV factors. So we are going to deal with understanding the basics of PV factor. Okay, PV factors. So listen carefully to the concept. Please, everyone concentrate, listen. Understanding the concept of PV factor. So PV factors is nothing but return expected for the risk taken. Return expected for the risk taken. So PV factor is nothing but the return expected for the risk taken. Listen carefully to the concept. Okay, I told you what you feel the time value of money, I know everything. We are now going to learn some new things. Okay, see here, I will roughly first tell. Year, cash flow, PV at the rate of 10%, PVCF. Like that you will write. Year 1, 2, 3, some amounts. 1 lakh, 2 lakh, 1,50,000, you have written 0.909, 0.826, 0.751, like that you have written. Some amounts you have given. This is called as a discounted cash flow. Discounted cash flow. So let us understand the motive. Year 1 in finance, 1 represents at the end of year 1, not beginning of year 1. Okay, this is end of year 2, not beginning. Sir, why sir? Why not beginning, sir? Why end? End is always a future. Beginning is always a present. Futuristic cash flows only should come here. That's why we will always understand year is a future years. Okay, 1 year later, 2 years later, 3 years later. Okay, so year 1, year 2, year 3. After 1 year, you are going to get 1 lakh. After 2 years, you expect to get 2 lakh. After 3 years, you expect to get 1,50,000. First tell me, these are all present years or future years or future years. These are all already happened cash flows or guaranteed cash flows or unguaranteed and expected. Unguaranteed and expected may happen, may not happen. Anything can happen now. Now tell me, these cash flows are having risk or having no risk? Tell me. Everyone should answer. No sitting silent here. There is no concept of sitting silent. Waste of time. Sitting silent is waste of time. So unguaranteed and expected. So these are certain, uncertain. Uncertain. Having a risk or not having a risk? Having a risk. Okay, having a risk. Okay. Now the question will come. For the risk taken, what you are giving me? That's why this risk amount we will multiply with the return part called as 10%. This is called as this amount, whatever you get after multiplying it, that will be the concept of payment that is left out after paying you the return. This concept we will discuss in capital budgeting area. Don't ask me about PVCF. Understand this one point only. These 3 years are futuristic years. Means they are uncertain, future, uncertain, predictable only. Okay, but we can tell that guarantee it will happen. So there is a involvement of risk. For that risk you should ask a return. That's why this return, so you will multiply that. Okay, But sir, when you multiply with return, why 0.90? That discussion we will make in another chapter. Separate discussion is there on that. But as of now, primitively, have you all understood the meaning of 1, 2, 3 or futuristic years, cash flow and multiplying this? This is the cash flows having risk. This is the return for the risk. Okay, so that's a cash flow, that's a risk. Okay, that's involved. Now the question, PV factor is nothing but return expected for the risk taken. Return expected for the risk taken. I am not yet done, please listen carefully. Further, year, cash flow, PV at the rate of some percent, PVCF we are taking. Okay, year 1, year 2, year 3, some amounts I have written, multiplied with some PV factors, I got one answer. Now listen carefully. This PV factor, how you got this 10%? Yeah, some mechanism should be there now for getting 10. Yes or no? For getting this 10%, there should be some mechanism. Correct? This mechanism of PV factor is having two elements inside this. Okay? Number 1, opportunity cost. Number 2, inflation. So number 1, opportunity cost. Number 2, inflation. How to understand that? That's what we are going to analyze now. So please listen carefully. And again, shall I tell you one point here? Listen. When I say students in the first day of the session, that time value of money will impact your learning. Student, do you know what they will think in general? Just sir wanted to keep us engaging in the class, day number 1. So even if he teach basics, I should concentrate. For that reason, he is telling like that. See, please listen carefully to my point. Seriously, I am telling you, not with that intention. I will show you the proofs to you now. Okay? In which topics we are going to understand this. What is this area here? Read. What is this area? What you are seeing now? I will show you the chapter name. See, what is the name of the chapter? What is the name of the chapter here? What you are seeing on the screen? Ten marks chapter. What is the second learning objective? You see on the screen and tell. What is the second learning objective? What is the second learning objective? What is the main concept there? Now you came to my point. Inflation. Do you know what we will do in this inflation area? Because sabal karo, see here. Same year cash flows, FCF means future cash flow, PV at the rate of required return, PVCF. How to understand that inflation in the cash flows, we are going to understand here. Okay, see, PV factor ki 3 breakups will be there. One is MR, RR, IR. That's what we have done. Clear? I'm not telling something to keep you engaging here. And in an exam oriented batch, I don't have the business to do. Do you know why I'm dealing with the basics first? Student, unless and until he have proper basics, actually he should not do AFM subject, because it will be confusing the moment you don't know the basics. Okay, but if you know the basics now, you will enjoy the subject like anything. Sky is the limit for your understanding as well. Okay, so please listen. PV factor is nothing but a return expected for the risk taken. Write down. Or not write down, I will explain. See here. PV factor is made out of two things: opportunity cost, inflation. Opportunity cost and inflation. What is this opportunity cost? Opportunity cost always represents the risk. inflation always represents the decrease of purchasing power. Like this, if I tell people don't understand, I will explain in your language, means in a easily understandable format. Just a minute, I will put it on charge. So in a easily understandable format, I will try to explain. See here, opportunity cost means a risk, inflation means a reduction in purchasing power. How to understand these two? Okay, let's have a clarity. Opportunity cost is a risk. Whenever, for example, I am having 1 lakh with me, 1 lakh rupees I am trying to deposit in a bank. 1 lakh rupees I am trying to deposit in a bank. I wanted to deposit this 1 lakh in a bank. If I deposit this 1 lakh in a bank said that I will give you guarantee 6% return on FD. Guarantee 6% return on FD. Okay. Now everyone in the class, please put the message here. Live you put a message. Okay. 6% given by the bank is certain, uncertain. Put the message. From you only I will give the answer. That 6% is certain, uncertain. Bank FD return. Certain, uncertain. 6% is certain. Okay. Now you answer. Thank you very much for replying. So you said that 6% is ultimately it is certain. Now the question starts. 6% is certain. No doubt about it. But now listen carefully. My friend came to me. He said, Kaushik, please give me this 1 lakh to me. Instead of giving it to the bank, please give it to me, he said. Okay. I asked him, why you want? He said, I am having a dire need of the fund. So please give me this 1 lakh to me rather than giving that money to the bank. I said, okay, I will give. Therefore, first of all, you think with some amount of a common sense and tell me, this fellow and bank, you compare. Bank, SBI and my friend, Mr. A. Okay. SBI is riskier, unriskier, unrisky. Okay, not risky. Do you know, SBI, even if it is closed, FDs of SBI are already insured by RBI. So even if SBI die, even if SBI goes insolvent, even if SBI liquidates, okay, I should not tell. Bank should always safe in India. People will die or else. Okay, so let us say, for example, even if SBI goes insolvent, even if SBI turns its tables and this SBI has liquidated, even in that case, okay, even in the case when SBI goes liquidated, still the deposits of the SBI will be insured. Okay, so the deposits of the SBI will be still get insured. Now there is no risk. Now you imagine, one side SBI is there, on another side your friend is there. Now tell me, who is more risky? Mr. A or SBI? Who is more risky? Bank is more risky? A is more risky. Don't tell friend is risky, yeah? It gives a wrong message. Not friend is risky. Mr. A in this example is risky. So, A is risky. Therefore, the question is, when you are giving money to A, okay, if you give that money to A, I repeat one more time, if you give money to Mr. A, what you are losing? When you give money to A, you are losing opportunity to invest in SBI, where it is risk free. You have 1 lakh. You have two options. Option 1 SBI, option 2 your friend. Option 1 SBI, option 2 your friend. SBI will give you 6% sure, certain return. Okay, your friend also said I will give you, your friend is there. Let us understand this way. SBI is risky, risk free. Once the moment you give this 1 lakh rupee not to SBI, but you gave that 1 lakh rupees to your friend Mr. A, you are losing an opportunity to get a 6% fixed, certain, undisputed return. Okay, that means you are losing the opportunity to get that 6% by giving it to him. So now the concept is what? You lost an opportunity to get a fixed return. This is a cost for you now. That's why we call it opportunity cost. This opportunity cost is the risk that you take. Risk that you take. For this opportunity cost, your friend should compensate. So what you should ask your friend, Mr. A, you took 1 lakh from me, correct? If I would have given to SBI, how much SBI will give me? SBI will give me 6. I am losing an opportunity to invest in SBI and I am giving it to you. So first give me that 6% minimum. Okay, minimum. First give me that 6% minimum. Sorry, I will give 6% minimum. Take. Enough? No. You are compensating me only for risk now. Then who will compensate me for the inflation? What is this inflation? Listen. India inflation is 5%. Actually it is 6%. 5.83 like that it is. So 6% you take. What do you mean by 6? 100 rupee product today will become 106 after 1 year. Means, sir, really that India is growing? No. Money value reduced. Product value increased. Sir, I didn't understand, sir. See here. Previously, I used to buy a product at 100 rupees only. That means 100 rupees is having a power to buy that product. Now, 106 rupees I should spend to get that product. Means, rupee lost its value, product gained its value. Okay, rupee lost its value. That's called as a reduction in purchasing power. That reduction in purchasing power, people popularly call as inflation. I will give an example also for this. You have 1 lakh with you. You have 1 lakh rupees with you. This 1 lakh rupees what you have with you, you wanted to buy an Apple iPad. You wanted to buy an Apple iPad costing 1 lakh. You went to the iStore, okay, and you ordered for an Apple iPad worth 1 lakh. He is about to give. Your friend came to you, okay. One minute here. So please listen. So your friend came to you and said that I want this 1 lakh. Okay. So you are about to give that 1 lakh. So what is your opportunity? First, you are having rupees 1 lakh. You wanted to put this 1 lakh and to buy the iPad. This is the idea behind. Your friend came and said, I want this 1 lakh. I want this 1 lakh. Then you said that, yes, I will give you 1 lakh. No doubt, I will give you 1 lakh. However, I wanted to buy an iPad today, but I am losing an opportunity to buy iPad. So I would have bought it, but if I give you, I will not buy this. Okay, I will not buy this. Sir, okay, for that I am paying opportunity cost 6%. Wrong. I repeat one more time. You are having 1 lakh. You are having 1 lakh. You are having two options, SBI, your friend. If you give it SBI 6% fixed return, friend, you should ask the same 6% because at least 6. You can ask more than 6 also. At least 6 you should ask because of putting money with SBI, you will get 6% fixed return. Because of not putting in SBI, you are losing an opportunity to get a fixed return. That's called as an opportunity cost. That's what you should ask. This is opportunity cost compensation. Risk compensation. SBI is risk free. Friend is risky. Friend is risky means I'm talking about context of finance. Mr. A is risky. Okay. For that risk taken, you should ask a return. That should be minimum 6% because you lost an opportunity of 6. Over. Then your friend said, or then you said to your friend, Arey, I would have bought an iPad today for 1 lakh. I would have bought an iPad for 1 lakh today. Because of giving you this 1 lakh, I lost opportunity of buying an iPad. I lost a opportunity of buying the iPad. So I have to buy in after 1 year, after you give me money. When you give me money after 1 year, then I have to buy an Apple iPad. Okay, understood. So you said, okay, for future I paid you already 6%. That 6% is for the risk taken. 1 lakh rupee iPad will not be same 1 lakh after 1 year. It will be 1 lakh 6,000 after 1 year because India average inflation is how much percent? 6%. Means you should compensate me for two things. compensation number 1 for the opportunity cost, pay me 6%. Okay, and inflation in India, for that also you compensate me for 6%. So because of giving money to you, I lost an opportunity to invest in a risk-free place, and I am also subjected to inflation. If I would have that money today, I would have bought an iPad at 1 lakh only. Because of you, I need to spend that extra 6,000. 6,000 on 1 lakh is 6%. That 6% you should only compensate me. Therefore, whenever you are making investment, how much return you should ask? You should ask that much return which compensates for opportunity cost and which compensates for inflation. In this case, 6% plus 6%, 12%. That's how the PV factors are formed. Everyone reply. Understood or not? Everyone reply. Understood or not? Clarity is there or not, everyone? Okay. So what you have to understand, whenever I said PV factor will have two components. One, the risk, opportunity cost. Second one, inflation. Whenever you are asking, you should ask compensation for both. Both what? Both risk as well as inflation. You think, just now I said, to motivate you in the basics of the class, I just wanted to tell you that these are important. Please. Okay. See here. This is international capital budgeting chapter here. Advanced capital budgeting, like international capital budgeting area. You saw this? Okay. See this. There are three types of rates. First one, advanced capital budgeting, this concept is there. Inflation rate, compensation for the inflation. Okay. Opportunity cost rate, risk rate, I said, that's called as a real rate in this chapter. Compensates for the risk. Okay. Total PV factor compensates for risk as well as inflation. That's called as a money rate. Compensates for both risk as well as inflation. Listening. Please don't think that basics I wanted to motivate you. That's why I'm telling you all these things. Please, I don't have that much time and that much nonsense to convey. Okay. So try to understand. These are important. Yeah, one should understand the basics first. On the basics, theories are drafted. Okay, on these basics, the theories came. So if you lose the basics now, there is no point of understanding. So say no to formats, say no to some mugging up of concepts, by hearting concepts. Okay, format like this you have to fill. Nonsense here. At the end of the day, you are successful. Maybe you are successful as a examination point of view, may be successful, but in understanding, you are not. So please take care of your understanding first. Okay, let's write the notes on inflation. PV factor is made out of two components. PV factor is made out of two components. So write down. One is opportunity cost. One is opportunity cost. Second one, inflation. Second one, inflation. Opportunity cost compensates for risk. So opportunity cost compensates for the risk and inflation compensates the decrease in the purchasing power of a rupee. Both should be compensated together. Okay, both should be compensated together. Another name is also there, also known as real rate, also known as inflation rate. Okay, both together is called as money rate. More about this is discussed in advanced capital budgeting chapter. So in advanced capital budgeting chapter, again and again you need not read. Okay, advanced capital budgeting chapter again and again you need not read. So directly if you read once here now, it is enough. Everyone, have you completed writing the notes? Those who joined the live. Okay, so PU factor is made out of two components, opportunity cost and inflation. Opportunity cost compensates for the risk, inflation compensates for the decreasing purchasing power of rupee. More about this is discussed in the chapter advanced capital budgeting. Okay, so some are saying that background has some noise is there. Now also it is there. Confirm? Did you find any noise now? Everyone please answer. Okay, thank you. So now what we understood, importance of PU factors, 2 points we completed. One is PU factor is nothing but the return for the risk taken, and PU factor is made out of two components, opportunity cost and inflation. Opportunity cost compensates risk, inflation compensates the decrease in purchasing power. This is also called as a money rate, this is called as inflation rate. Okay, this is called a real rate, this is called as inflation rate. Both together will be called as a money rate. So more on this we will be discussing in the chapter called as advanced capital budgeting. So this is the thing that we learned. Okay, here I will stop for today, the first day session. So next session what we are going to start is, we are going to understand streams of various cash flows which are relevant for our syllabus. There are various different streams of cash flows are there. Single cash flow, okay, single cash flow, annuity cash flow, multiple uneven cash flow, perpetual cash flows, all are applicable for your syllabus. Again I am telling, not to just tell the basic, these are all applicable for your exam. With the proofs I will show you which chapters you will find what kind of cash flow. Okay, once you understand the streams of cash flow, we will understand how discounting and compounding works. After that, the formula for discounting and compounding, how the formulas are derived, why we divide for discounting, why we multiply for the compounding, a basic maths that is involved inside that. And moreover, the most important thing we are going to learn is reinvestment concept. All these in the first 2 hours we will complete in the next session, and then we are going to start with our first very important 10 marks to 12 marks area called as Forex. We are going to start with, okay, tomorrow's session we are going to start with Forex after the basics are over. Okay, so everyone in the class, please tell me, are you all having a full clarity on the basics clearly up to here, the first day of the session? Okay. Okay then. And please inform all your friends also who are in the need of AFM that the live classes have started, and this is a 30-day session. And again, if at all in any of the days, if I have to put a session in the evening instead of morning, I will let you know in advance. Okay, if at all if there is a possibility, if I have to conduct the class in the evening time instead of the morning, I will let you know very much well in advance. Clear? Same 4 hours like that, for example 5:30 to 9:30, like that, if I have to take on any day, I will let you know in advance. Okay, so this is the thing I wanted to convey. Okay, thank you very much. We'll meet you again in the tomorrow session. First 2 hours basics, next one the main chapter called as a Forex, a 10 to 15 marks chapter we are going to start in the next class. Thank you very much. Have a nice day. We'll meet again in the tomorrow's class. So please tell to your friends about the live session. Okay. So tomorrow class time 7:30. I told her first to 3 days 7:30 to 10:30 like that. From then 7 to 11:30. Okay then. Thank you very much.